Hey everyone, and welcome back. Today, we're talking about the ultimate financial dream, passive income. Specifically, how to build an investment portfolio that pays you $100 a day, that's over $36,000 a year purely from dividends. Most people think dividend investing is for retirees. They think it's slow, boring, or that you need millions to start. That couldn't be further from the truth. This strategy is for anyone who wants cash flow now and financial freedom later. Over the next few minutes, we are going to break this down into 3 simple phases. Phase 1. The math and the mindset, how much capital you actually need. Phase 2. The core strategy, the 3 types of dividend assets you must own. And Phase 3. The portfolio blueprint, my 7 favorite sectors, and an actionable watch list of stocks and ETFs to start building today. Get your notebooks out because we're diving in. Let's get the big question out of the way. How much money do you need to generate $100 a day? Well, $100 a day is $36,500 a year. To figure out the required capital, we need to choose a target dividend yield. A high-quality, sustainable dividend portfolio should aim for a gross yield of about 3% to 4%. Let's use 4% as our benchmark. So, the magic number. To get $36,500 per year at a 4% yield, you need approximately $912,500 invested. Now, don't let that number scare you. The journey of dividend investing is all about 2 things: time and compounding. This is where the snowball effect comes into play. Your dividend portfolio should be structured to have a dividend reinvestment plan, or DRIP. Every time you get paid a dividend, it automatically buys more shares. Those new shares then pay dividends, which buy even more shares, and so on. This is how you exponentially accelerate your growth and hit that $912,500 goal much faster than simply saving cash. Now, let's talk about the mindset, specifically the low yield, high growth myth. Many beginners only chase high yields, 8%, 10%, even 12%. This is the single biggest mistake you can make. A sky-high yield often signals a fundamental problem with the company, or that the dividend is unsustainable and likely to be cut. We are looking for dividend quality and growth, not just the highest initial yield. Stability is your foundation for that $100 a day. To build a resilient, high cash flow portfolio, you need a balanced approach. I break this down into 3 mandatory asset pillars: the foundation, the accelerator, and the high-octane income. Pillar 1 is the foundation, making up 50% to 60% of your portfolio. This is made up of low-cost dividend ETFs. These provide immediate diversification and reduce single stock risk because you buying a basket of hundreds of dividend payers. Look for ETFs that track indexes based on dividend growth, not just yield. Key ETFs to research include VIG, the Vanguard Dividend Appreciation ETF, and SCHD, the Schwab US Dividend Equity ETF. These focus on companies with a long history of increasing their dividends. Their yields might be lower, around 2 to 3%, but the safety and growth they provide are irreplaceable. Next, Pillar 2 is the accelerator, which should be 30% to 40% of your allocation. This is where you invest in individual dividend growth stocks. Think of the dividend aristocrats or kings, companies that have grown their dividend for 25 or even 50 consecutive years. They read the accelerator because their dividend raises beat inflation and increase your yield on cost over time. A key metric to check here is the payout ratio, the percentage of a company's earnings paid out as a dividend. A payout ratio over 70% can be a red flag. Aim for a sweet spot of 30 to 60% for long-term safety. Finally, Pillar 3 is the high-octane income, a small 5 to 10% allocation. This is for specialized assets like REITs, real estate investment trusts, and MLPs, master limited partnerships. They are legally required to pay out most of their income, which often leads to yields of 5 to 8%. The catch? REITs and MLPs are sensitive to interest rates and specific industries. They are also best held in tax-advantaged accounts like a Roth IRA due to the tax treatment of their distributions. Use this pillar sparingly just to boost your overall portfolio yield. Now that we have the structure, let's build the blueprint. A safe dividend portfolio must be diversified across sectors. I like to break a dividend portfolio into 7 key defensive and stable sectors: consumer staples, healthcare, utilities, financials, industrials, technology. Yes, tech pays dividends now. And real estate, which is your REITs. Let us look at a quick watch list of stocks and ETFs that fit perfectly into pillars 1 and 2. Just a quick note: this is for educational purposes only and not individualized financial advice. For your foundation, stick with solid choices like SCHD and VYM. For your accelerator stocks, consider defensive giants like Johnson & Johnson and Coca-Cola, or growth-oriented tech like Microsoft, and stable utilities like NextEra Energy. Finally, for your high-octane income, you could look at Realty Income. Ticker symbol O. It's a retail REIT that conveniently pays its dividend monthly. This brings us to the monthly income ladder. Generating $100 per day doesn't mean you get a check every 24 hours. Most companies pay quarterly. To smooth out your income, you need to build a ladder by selecting stocks and ETFs that pay dividends in different months. For example, some pay in January, April, July, and October, while others pay in February, May, August, and November. When you build this ladder correctly, you'll have dividend payments hitting your account every single week, making that $100 a day goal feel much more consistent and real. So here is the final simplified strategy. Step 1. Set your target. You need to save and invest close to $912,500 at a 4% yield to reach your goal. Step 2. Allocate by pillars. Put 50 to 60% into growth ETFs, 30 to 40% into growth stocks, and a small 5 to 10% into high yielders. Step 3. Drip everything. Set up a dividend reinvestment plan on all your holdings to put compounding on autopilot. Step 4. Stay consistent. The most successful dividend investors are the most boring. They invest the same amount every month, regardless of what the market is doing. That is how you win in the long run. This really is the most important lesson in dividend investing. You don't need to be a genius. You just need to be patient and consistent. Stick to the 3 pillars, reinvest your dividends, and over time, that snowball will grow to give you the passive income you deserve. If this video helped you build your blueprint, please hit that like button. It really helps me know what content to make next. And if you're new here, subscribe for more simple, actionable financial advice. Now go execute your plan. Thanks for watching, and I'll see you in the next video.